Let us build the Black-Litterman model slowly, as if we are standing at a blackboard. The paper is Fischer Black and Robert Litterman's Global Portfolio Optimization, published in the Financial Analysts Journal in 1992. The problem sounds technical, but the human problem is simple. Portfolio managers wanted optimization. They wanted a disciplined way to mix global stocks, bonds, and currencies. But the classic optimizer was too jumpy. Tiny changes in expected returns could create huge changes in portfolio weights. One asset might become a giant long position. Another might become a giant short position. The math looked precise. The portfolio looked strange. So Black and Litterman asked a better question. Instead of asking, "What is my forecast for every asset in the world?" they asked, "What does the market already believe?" Then they asked, "Where do I have a real reason to disagree?" Start with the older Markowitz setup. Mean variance optimization needs three ingredients. It needs expected returns, it needs risk, and it needs correlations, which tell us how assets move together. If those inputs are good, the optimizer can be useful. But expected returns are the weak link. They are estimates, they are noisy, they are often guesses with decimal points. The optimizer does not know that. It treats a weak forecast like a fact. That is why small forecast errors can become large portfolio bets. This is the disease that Richard Michaud called error maximization. The optimizer does not just use the input error, it amplifies the input error. Now imagine a simple global portfolio. Suppose the market has 45% in US equities. It has 25% in European equities. It has 15% in Japanese equities, and it has 15% in bonds. These numbers are not perfect. They are not holy, but they are not random. They are the result of real investors buying and selling real assets. That market portfolio is Black-Litterman's anchor. If you have no special view, you do not need to invent a full forecast table. You can start from the market. That one move already calms the optimizer down. The starting point is no longer a spreadsheet full of fragile return guesses. The starting point is a neutral portfolio. The first equation is reverse optimization. It is written as pi equals delta times sigma times W MKT. Here, pi is the vector of equilibrium expected returns. Delta is the risk aversion parameter. Sigma is the covariance matrix, which maps how assets move together. And WMKT is the market portfolio weight vector. Read the equation from right to left. Start with the portfolio the world already holds. Combine it with the risk map. Scale it by risk aversion. The output is a set of implied returns. These are the returns that would make the market portfolio make sense inside the model. That is why the process is called reverse optimization. Normal optimization goes from returns to weights. Reverse optimization goes from weights back to returns. This is the first lesson on the board. Equilibrium is not truth. It is a disciplined default. It is like walking into a crowded restaurant in a city you do not know. You can see what everyone ordered. The crowd might be wrong, but the crowd is information. If you know nothing else, you do not start by ordering the strangest item on the menu. You start with the revealed choice of the room. The market portfolio plays that role. It gives the model a calm prior. Prior is just a fancy word for starting belief. But investors are not forced to accept the market. Black-Litterman is not passive investing with extra notation. It lets the investor add views. A view might be absolute. For example, US equities will earn 7% over cash. A view might be relative. For example, US equities will beat European equities by 2%. Relative views are often more realistic. Many investors are better at ranking opportunities than forecasting exact returns. They may not know that US equities will return exactly 8.2%, but they may have a reason to believe US equities look better than European equities. Black-Litterman gives that kind of view a clean place to live. Now add confidence. This is the part that makes the model feel practical. In real life, investors rarely hold every view with the same force. One view might be strong, another might be tentative. A committee might say, "We like U.S. credit, but not enough to make a huge bet." Traditional optimization struggles with that nuance. Once a return forecast enters the machine can treat it too aggressively. Black-Litterman turns confidence into a volume knob. Low confidence means the view nudges the portfolio. High confidence means the view pulls harder. The model does not just ask what you believe, it asks how sure you are. The blend can be described in plain English. Start with equilibrium returns. Add investor views. Weight those views by confidence. The result is a blended return estimate. Only after that do you optimize. So the optimizer is no longer eating raw forecasts. It is eating forecasts that have been anchored and disciplined. That is the second lesson on the board. Views are allowed, but views must earn their impact. Let us use a toy example. The neutral market portfolio has 45% in U.S. equities, 25% in European equities, 15% in Japanese equities, and 15% in bonds. Now suppose you believe U.S. equities will outperform European equities by 2%. A raw optimizer may react too strongly. It might push U.S. equities to 80%. It might make Europe negative. That is hard to explain to a client. It is also hard to hold through a bad month. Black-Litterman takes the same view and asks for confidence. If confidence is moderate, the U.S. weight might move from 45 to 52. Europe might move from 25 to 18. Japan and bonds might stay close to neutral. The portfolio changed, but it did not become a cartoon. That is the third lesson. The model turns opinions into tilts. It does not turn opinions into a whole new world. This is why institutions like the method. A pension committee can start with a policy portfolio. Then it can state a few views. It can say where it has conviction. It can say where it is uncertain. The final portfolio has a story. Here is the neutral benchmark. Here are the views. Here is the confidence. Here is the resulting tilt. That structure is easier to govern than a mysterious optimizer output. There is still a catch. The market portfolio can be a bad anchor when the market is badly wrong. In 1999, the market portfolio had a large technology weight. Before the 2008 crisis, market prices carried the crowd's confidence in financial risk. Equilibrium returns are inferred from the market. If the market is euphoric, the anchor inherits some of that euphoria. So Black-Litterman is not a truth machine. It is a discipline machine. It improves the process. It does not remove judgment. There is a second catch. Confidence is hard to measure. A person can say, "I am 70% confident." But what does that mean? Is it based on data? Is it based on a meeting? Is it based on a story the committee likes? Black-Litterman gives confidence a place in the model. It does not cure overconfidence. Bad views are still bad views. Political views are still political views. The model makes judgment visible. It does not make judgment perfect. This is why the best takeaway is simple. Do not ask an optimizer for the perfect portfolio. Ask how far you should move away from a reasonable default. Start with the market. State the views you truly have. Size each tilt by confidence. Then check whether the result is still a portfolio a human can explain and hold. That is Black-Litterman in one sentence. It is not a better crystal ball. It is a better steering wheel.